March 1987, the Persian Gulf. A Japanese oil tanker cuts through dark waters, heading toward the narrow passage between Iran and Oman. The crew knows the risks. This stretch of sea has a name now: the Death Corridor. That year, 178 tankers were damaged or destroyed in these waters. Missiles struck without warning. Mines floated beneath the surface, invisible until too late. Insurance companies refused to cover the routes. Captains demanded triple pay. And still, the oil had to move, because 21% of the world's petroleum flows through this 34-mile channel. Every single day, nations depend on it. Economies rest on it. And when the Strait of Hormuz trembles, the entire financial system feels the vibration. But there's something else moving through these waters besides oil, something older. Something that doesn't burn, doesn't corrode, and doesn't disappear when the tanks run dry. And that raises a question most people never think about. When the world's most critical oil passage closes, when supply chains fracture and panic spreads through trading floors from Tokyo to New York, what actually holds value? How many barrels of oil does it take to buy 1 ounce of gold when the system shakes? The answer reveals something deeper than commodity prices. It exposes how financial systems behave under pressure, how trust migrates during crisis, and why certain assets survive while others collapse, which leads to a problem every financial system eventually faces. This video examines the relationship between oil and gold through the lens of the Hormuz crisis, not as prediction, not as theory, but as historical test. We'll look at what happened in 1987 during the Iran-Iraq War. We'll examine the 2019 tanker seizures that sent prices spiking. And we'll analyze the 2026 closure that pushed Brent crude near $120 per barrel. These are real events, real market reactions, real consequences. To understand what's happening, we need a framework. 3 tests that reveal how assets behave when geopolitical shock hits the energy system. The first test measures immediate price reaction. When crisis strikes, which asset moves first, which moves faster, and by how much? The second test examines duration. How long does the spike last? Does the asset hold its gains, or does it retreat once the headlines fade? The third test looks at purchasing power. Not the dollar price, not the percentage gain, but what you can actually buy with each asset when the dust settles. Let's begin with 1987. The Iran-Iraq War had entered its 7th year. Both nations understood a simple truth. Destroy the other's oil exports, and you destroy their ability to wage war. So they attacked the tankers. Iraq struck first. Iran responded. The Persian Gulf became a battlefield. Oil prices jumped from $13 to $40 per barrel in a matter of months. A short-term increase of over 200%. Shipping companies rerouted. Some vessels turned back. The insurance market froze, but gold moved differently. While oil spiked on fear of supply disruption, gold climbed on fear of something else entirely. Currency instability, inflation expectations, the quiet worry that if oil could be weaponized this easily, what else might break? By the end of 1987, the gold-to-oil ratio had shifted. 1 ounce of gold, which might have purchased 15 barrels at the decade's start, now bought closer to 12. Oil had gained ground, but not as much as the headlines suggested. Here's what that tells us. Oil reacts faster to supply shock. Gold reacts slower but with more endurance. Oil spikes on scarcity. Gold climbs on uncertainty. Now move forward to 2019. May, the Gulf of Oman. 4 commercial vessels suffered sabotage attacks. Blasts tore through hulls. Investigators found limpet mines attached to the metal. Blame pointed toward Iran. Tensions escalated. Oil prices surged 5% in a single day. The strait remained open barely. But the message was clear. This passage could close. And if it did, the consequences would ripple through every economy on Earth. The gold-to-oil ratio sat around 17 barrels per ounce, within its historical average. But notice what happened next. As tensions cooled, oil prices retreated. The headlines moved on. Traders returned to fundamentals. Supply remained adequate. The fear premium evaporated. Gold held steadier. It didn't spike as dramatically, but it didn't fall as far either. This is the second lesson. Oil prices mean revert. Gold prices persist. Oil responds to physical supply. Gold responds to monetary confidence. When the crisis passes, oil returns to production costs. Gold returns to trust levels, which brings us to 2026, March. The current crisis, the largest oil supply disruption in modern history. The Strait of Hormuz has closed. Iranian forces have blocked the channel. Military engagements are underway. Brent crude approaches $120 per barrel. Gas prices in the United States have jumped 17% since the conflict began. Asian markets face immediate shortage risks. 84% of crude flowing through Hormuz was destined for Asia. That flow has stopped. The gold-to-oil ratio has surged past 50 barrels per ounce, far above its average of 18 since 2000. This isn't normal, this is systemic stress. Why such a dramatic shift? Because this crisis isn't just about oil supply. It's about what happens when the world's most important energy choke point becomes a war zone. It's about the realization that modern economies rest on assumptions that can vanish in days. Oil is essential, but oil is vulnerable. Pipelines can be severed, tankers can be sunk, wells can be sabotaged. The physical infrastructure of energy is exposed to geopolitical risk in ways that gold simply isn't. Gold sits in vaults. It doesn't degrade. It doesn't require shipping lanes. It doesn't depend on anyone's permission to retain its properties. Consider the 1950s and 1960s. During those 2 decades, when gold prices were fixed at $35 per ounce and oil prices remained stable under the Seven Sisters cartel, the ratio held between 11 and 13 barrels per ounce. Predictable, calm, the post-war order functioning as designed. Then came the 1970s. The Nixon shock ended gold convertibility. The OPEC embargo shattered oil stability. Both assets repriced. The ratio climbed toward 30 barrels. The system was finding new equilibrium through volatility. The 1980s brought war. The 1990s brought the Gulf War and another Hormuz scare. The 2000s brought financial crisis and the ratio exceeded 40 barrels in 2008. The 2020s brought pandemic and the ratio peaked again as COVID-19 boosted gold while cratering oil demand. Each time the system stresses, the ratio tells a story. Oil preserves energy access. Gold preserves purchasing power. Oil protects against shortage. Gold protects against collapse. When Hormuz opens, oil flows and economies function. When Hormuz closes, oil becomes scarce and gold becomes insurance. This isn't about choosing one over the other. It's about understanding what each one does. Oil is the bloodstream of modern civilization. Without it, transportation stops. Manufacturing halts. Supply chains freeze. But blood can be spilled. Blood can be blocked. Blood requires constant circulation. Gold is the memory of value. It remembers what currencies forget. It holds what paper promises cannot. It doesn't generate income. It doesn't produce yield, but it doesn't depend on anyone else's ability to deliver. Think about what happens in a true crisis, not a headline crisis, a system crisis. When the lights go out and the pumps run dry, oil becomes useless without infrastructure. Gold remains tradable without electricity, without networks, without permission. This is the distinction that matters. Oil is a flow asset. Gold is a stock asset. Oil must move to have value. Gold must simply exist. During the 1987 tanker war, captains who held oil contracts gained on paper, but those who held gold could actually cross borders. They could settle debts. They could preserve wealth across jurisdictions that were suddenly hostile to each other. The same pattern appeared in 2019. Traders who bought oil on the tanker attack news made quick profits, but those profits vanished within weeks as tensions eased. Gold holders saw smaller gains, but those gains remained. So how much oil for 1 ounce of gold during a Hormuz crisis? The historical answer ranges from 11 barrels in calm periods to over 50 in acute crisis. The current moment sits at the extreme end. But extremes don't last forever. The practical takeaway is simpler than the numbers suggest. Oil protects liquidity in normal times. Gold protects wealth in abnormal times. Oil responds to supply and demand. Gold responds to trust and fear. Oil is a commodity. Gold is a counterweight. 1 ounce of gold, 50 barrels of oil. In crisis, that's the exchange rate. In calm, it drops to 15. The spread between them measures system stress more accurately than any economic indicator, which raises an interesting question for you. If you were building a position today, knowing what you know about how these assets behave under pressure, which would you prioritize? Would you bet on the asset that powers civilization, or the asset that outlasts it? What part of this pattern surprised you most? Was it the speed of oil's reaction, the endurance of gold's hold, or the sheer range between calm and crisis ratios? Is there anything you disagree with? The historical record is clear, but interpretation always leaves room for debate. Perhaps you see different lessons in the 1987 data. Perhaps you believe the 2026 situation will resolve differently than previous crises. Most people watch oil prices and see only fuel costs. They watch gold prices and see only investment returns. They don't see the relationship. They don't see what the ratio reveals about system stability. A smaller group studies these patterns. They understand that assets don't exist in isolation. They exist in relationship. And those relationships tell stories that headlines never capture. Understanding systems doesn't guarantee outcomes, but it provides perspective. It allows you to see pressure points before they break, to recognize patterns before they complete, to position yourself not on prediction, but on preparation. The difference between the two groups isn't intelligence, it's attention. Most people look at prices. The thoughtful few look at ratios. Most people watch today. The prepared watch decades. History doesn't repeat exactly, but it rhymes. The Strait of Hormuz has closed before. It will open again. The ratio will normalize until the next crisis, until the next test. And when that moment comes, you'll know what to watch. Not the headlines, not the predictions. The ratio, the relationship, the pattern beneath the noise. The pattern is still unfolding. We'll explore more of these systems in future videos.